Okay, thank you very much and welcome back to yet another session in bank operations, lending, and international business. Okay, I think in unit one we did a couple of things. If you remember, we did do a good job in terms of laying the foundation. Yeah, a couple of things were looked at. Issues to do with what a bank is really, just to have that understanding. The critical concept of financial intermediation, we're able to do that. And I think even just the licensing process in Zambia was tackled. So we are on the right path. But now, I think today we have to look at we want to understand basically how deposits work, right? So we have to look at how deposits work. Um, so basically deposit management and so on. Okay, and then we critically need to look at money creation by banks. Okay, it's very important for us to understand that actually banks create money. Okay, um, through their credit extension process. Okay, so that is something that we need to look at. Issues of how liquidity is managed, we definitely have to capture that. And then also, what about the day-to-day running or operations of the bank? That is yet another thing that needs to be looked at. And of course, we'll also look at assets liability management. Okay, all right. Okay, fine. I think what is critical here is as we are building the foundation again to your banking you know career. I think the issue of deposits has to really be understood, because really deposits are a raw material. Deposits are a raw material. Okay, they are a raw material to banking or of banking. Okay, actually, without deposits, I don't think there's a bank that can function. Okay, so and that is why we need to dive into why this really matters a lot, and that will be our discussion. Okay, but of course we'll have to define and look at the different types of deposits. Okay, all right. Okay, so in defining, we are able to see there that a bank deposit is just it's simply money which is placed with the bank. Okay, it is money which is placed with the bank. Okay, where the bank promises to retain it. Okay, okay. So it is placed with the bank, but the bank promises to retain this money. Okay. Now, this can either be immediately on demand, right? Okay, this can either be immediately on demand, or it could be that it is supposed to be repaid at an agreed future date. Okay, so this sentence here is very critical. What we are saying is that deposits are the bank's primary liability. Wallace, I mean, and again, on the flip side, if you look at the issues of contra entry, you find that on the customer side, that is considered as an asset. Okay, so if you're a customer, Manasseh, as a customer, okay, I can have my balance sheet, assets, and maybe liabilities. Okay, so if I have deposited some money, say 10,000 with FNB, then to me this is an asset. But meanwhile, FNB, okay, this deposit that I've made, okay, is actually a liability, okay, of 10,000. So basically that is how you need to look at it. So this perspective is very important, okay, very important. So they are getting, so banks are getting all these monies from thousands and thousands of their customers, okay, and that is why we are saying really that is their primary liability, and actually the biggest, okay, source of the funding. If you look at here, we are saying that deposits typically make up 70 to 90%, of the banking of the bank's total funding. This is very critical, okay, this is very critical, and that is why we even when we go out there, in industry, we need to know that we have to respect, our customers. They are our source of funding, right? Our depositors, all these people having savings accounts and so on and so forth. And also advertising, or I mean investing in marketing as well, so that we can get as many customers as possible, okay. So I hope you are now able to appreciate why we say that really they are a lifeblood of the commercial banks. Okay, so depositors, very important. Okay, very important. Okay, so sorry. So let's quickly go to the different types of bank deposits. I think it is very important. We'll look at five classifications here, and we're looking at it from the the customer's point of view, right? So if you look at the common ones, you'll find that you have what we call the demand or current deposits. So here what we are saying is that really you can withdraw at any time, right? So this is the current account, so you can withdraw at any time, but of course the trade-off here is that you are earning little or no interest, right? That is the trade-off. Yeah, because I mean the thinking here is on the part of the bank is that uh, you know the bank can't rely on this money, okay. The bank can't rely on this money because um, this money is not staying for long, so we can't assume that this money will stay long, because someone might actually come and withdraw tomorrow, and so it would disappear tomorrow, okay. So that is why we offer very little interest, if any, on that. So yeah, it is cheap to raise, but very unstable, especially from the bank's perspective. Okay. So yeah, so basically this is what you would use in your daily transactions. So easily accessible money. Okay. So as we are going through this, try and see where you fall, for those that may already have bank accounts, so that you confirm which type of accounts you have. Okay. Quickly, there is also the savings, okay, account. Now for the savings account, I think so these ones will definitely pay slightly more interest, right? um and to the bank, this is quite stable, okay. This is quite stable because you'd find that at least people would maybe leave these savings alone, maybe not touch them for a while, right? So it is more stable than the current account that we just discussed, okay, earlier. um Yeah, so that is basically that. So I think at this time, just so that you can relate, you'd find that in case of in the case of Zambia, a lot of these saving products now can be seen through the different mobile providers. I'm sure you have noticed that MTN, Airtel have these products. So a lot of ordinary Zambians now are able to save, right? And this is all part of financial inclusion. So financial inclusion has really grown over time as a result of mobile money. I just thought I could mention that. Um, the other one is obviously the notice deposit. Okay, okay, the notice deposit. Okay. So in terms of liquidity, intermediate, moderate. But what happens with this is that this type of deposit, requires that you give the bank advance warning before you actually withdraw. Okay, so they may ask that maybe you inform us 30 days or 60 days before you actually withdraw. Okay, now because of this stringent measure, you'd find that at least the interest is a bit high on the part of the customer, right, to compensate for that. Okay, yeah. So, but for the bank, I think the advantage here is that the bank can is benefiting because they can prepare for an outflow. Okay, okay. So a bank can prepare for an outflow. That is really the advantage that you find here. Okay. So yeah, so that is about the notice demand. The next is the fixed term. I mean the fixed or term deposit. Yeah, so for this one, really, it's a very stable, at least, okay, yeah, this one is a stable source of funds, really, for banks. So as much as possible, let us see if we can secure, stable funding for our banks, okay? Because what is happening here is that the customer and the bank agrees to lock in their money for a certain period of time, maybe 90 days, 6 months, or even a year, right? Okay, even a year. Okay, to the extent that if a depositor wants to withdraw much earlier than agreed, it would actually cost the depositor um, to do that. Okay, so this really provides the highest interest. So in terms of interest, very high. Okay, very very high. Okay, yeah. So especially for depositors who don't need their money like immediately, this is what you are going for. Okay, you are going for a fixed or term deposit. All right. Other things, the last one that we can talk about is the negotiable CDs, okay, or negotiable commercial, I mean, certificates of deposits. Now, these ones, mostly you'd find that these are deposits really that come from mostly institutional investors. Okay, institutional investors, for example, maybe NAPSA in Zambia. Okay, insurance companies, corporations. So these are large, institutional investors that want to make, a deposit. And what is very unique about this, and we'll talk about them as we go in our our banking program, is that, remember, this is actually, what is unique is that this is tradable. Okay, it's a tradable instrument. It's actually a short-term instrument. Okay, and we'll talk about it a little later, maybe in money banking and financial markets. That's why we'll discuss it a bit more. But as a foundation, I think it is very important that you appreciate what we call the negotiable certificates of deposits. Okay. Yeah. Okay. Maybe just to even highlight a bit more, what we mean by tradable is that you can actually you can actually sell on the secondary market. You can sell this certificate of deposit on the secondary market. So, imagine you're an institutional investor, and then you push in, 100,000 kwacha for a certain period of time, maybe say 1 year, right? Maybe 1 year. But then at 8 months, maybe you are in need of liquidity. Now you know that if I go to the bank to get this money, it has not yet reached maturity and I may be charged, right? So what you do is you go to the secondary market where you find a buyer who can give you who can give you maybe say the 100,000 kwacha, and then you tell them that they take up this deposit and see to its maturity of a year, where they will get the 100,000 kwacha plus the interest. Okay. Yeah. Or if not, then you find that we can discount this. Okay. So instead of the 100,000 kwacha, maybe you look for someone who can give you a 90,000 kwacha, and then they can wait for maturity and be able to get something out of that transaction. So that is that. Okay. That is basically that. But we'll appreciate them a little bit more as we go on in this course. Okay. Okay, so yeah, so I was saying this is just the comparison section. I know you noticed that there's some amount of trade-off that we need to do when you look at deposits, both from the bank's perspective but also from the customer's perspective. Okay. Now, this comes in terms of, so the trade-off comes in terms of the issue of liquidity and the issue of interest. Now, interest is a cost, okay, on the part of the bank, but obviously it is a gain on the part of the customer, isn't it? Now, when you look at current deposits, you can see that the trade-off there is that it has got the highest liquidity. It's a current account. You can get your money at any time. But in terms of the costs to the bank, it is basically zero or no cost, isn't it? And in terms of this source of funding, you find that the stability for the bank is very low. Okay. Yeah, and then the best usage, you can be able to look at that. Businesses daily usage, you want to have a current account. Okay, so please let's advise our customers correctly, looking at what they want to do. Okay, a couple comes to you and they say they want to to begin saving towards buying maybe maybe buying a fridge, or maybe they want to buy a bed or something of that nature. They may want to do a savings account, right? Okay, so the savings account liquidity is high, not the highest, but it is high, and because of that you find that interest begins to correspond as well. So there's a bit more interest that you get. Stability as well is also moderate, And like I mentioned, this is common for individuals and households. Quickly, the notice deposit, you find that it is moderate. Okay, mostly for SMEs and flexible savers. Fixed or term deposits, liquidity is quite low. I think we talked about this. You actually have to agree with the bank in terms of when you would get you want to make a deposit. I mean a withdrawal. Okay, and you might lock in your money for a particular period of time. So interest, okay, the highest actually, okay, and then stability of this source of funding for the bank is high. So it is mostly common for long-term savers and even corporate. And then the unique one is the the negotiable commercial, certificate of deposit. Okay, this is liquidity is high because of its tradability, the fact that you can trade it. Okay, okay, interest rates competitive. Okay, and then stability for the bank, this source of financing definitely high. Okay, and then it is being used by institutions and in short institutional investors. So that is that. So the key here is that the more liquid the deposit is, the cheaper and less stable it is for the bank and vice versa. As simple as that. Okay, so remember this, please. Okay, so really, after talking about what we have talked about, I think we have understood what deposits are, um, and just that interplay, the relationship that we discussed, the trade-off. Now, you should know that that is actually the foundation of deposit management. Okay, it is very important. So now we want to look at so since we have understood deposits, so we now want to look at how the bank actually manages these deposits, right? So how does the bank manage these deposits? Okay, in terms of how does the bank decide how much to pay on these deposits, the interest to pay on these deposits. Okay, even the issues of reserves, okay, reserve requirements. Okay, how does the bank decide how much, okay, reserve to keep aside? Okay, so reserves usually, this is money that is not borrowed. Okay, so from the deposits that you come up with, if for example you have deposits of 10,000 and you only lend out 6,000 for example, then it simply means that your reserves are at 4,000, isn't it? Okay, sorry, 4,000. Okay, so that's just about the reserves. And then also we are saying, okay, fine, how do we protect our customers if the bank fails, right? So all those are answers that we have to provide as we look at this other section now. Okay, so when it comes to managing the cost of deposit, what is very profound, what is needed here is for us to understand how we find the cost of funds. This is very important. So the cost of funds is equal to the total interest paid on deposits divided by the average total deposits, and then you multiply by 100. So that is simple mathematics. For example, what are we saying here? So for instance, look at a situation where maybe a bank is paying, okay, the bank is paying, for example, 50 million, okay, 50 million in terms of interest. Okay, so it is paying 50 million in terms of interest on maybe say a 1 billion, okay, on a 1 billion of deposits. Okay, on a 1 billion of deposits. Now, going by our formula here, it simply means that we are saying that this will have to be you know 50 million, okay, divided by, so 50 million divided by 1 billion, isn't it? Okay, and then you find that your answer here is is 5%. All right, your answer here is 5%. And so this is the cost of funds. Now, it is critical, this cost of funds, because we are saying that if, for example, your lending rates, okay, as a bank, okay, sorry, I'm congesting this, but for example, your lending rate is 8%, for instance. If your lending rate is 8%, then it simply means that your profit margin here is 3%, isn't it? The difference between 8% and the cost of funds. Okay, and this is something that is closely monitored, because if, for instance, the deposit cost rose to maybe 7%, if it rose to 7%, then it means now you have 1% in terms of profit margin, and that means that your profit have been squeezed. So these are real, situations that happen. Yeah, there's been many periods, like for example, the in 2022, 2023, there was a period where globally there was just this rapid increase in interest rates. Okay, so these things do actually happen, but the question is, who actually manages this, right? Okay, who actually manages this? Management of this is the ALCO. Okay, ALCO is the Asset Liability Committee. Okay, so these are the ones that would actually set these deposit rates. Okay, all right, so usually they would meet monthly to set deposit and lending rates. Very, very important committee, this one. If you look at the membership of this committee, it is mostly senior management, senior people in the bank. For example, the CEO, the CFO, the chief risk officer, head of treasury. Okay, so these are the people. And so yeah, so basically let us see if we can get to such kind of committees. Okay, it's a very interesting one. Now, what are the factors that would affect? Okay, what are the factors that could affect um, the deposit rates? Okay, definitely it is, first one should have to be the Bank of Zambia's monetary policy rate, isn't it? Okay, and then also because they are in a competitive environment, then it means that you know competitor deposit rates will also affect the deposit rates that they come up with. Okay, other things that they look at, this ALCO committee, as they are trying to set these rates, they also look at the bank's current liquidity position. What is the current bank's liquidity position? Okay. Also, they have to assess the impact on the net interest margin. Okay. I'm sure you remember this very important variable, the net interest margin. Okay. And then also they are looking at issues of customer segmentation. For instance, the retail versus what? The corporate. Okay. So that is that. Otherwise, ALCO is the most important, governance body for balance sheet management in any commercial bank. Okay, in any commercial bank. I think that is critical. Okay. Okay, yeah. So very, very, very critical information. Before I forget, as of 2026, the Bank of Zambia actually put the MPR, or the monetary policy rate, was actually dropped to 13.5%. Okay, so depending on when you view this video, but 2026 February dropped to 13.5%. I think reasons had to do with the reduction in inflation, the kwacha, gaining in terms of value, stability in terms of the copper prices, actually rising copper prices. I think even just the favorable a weather pattern that has been experienced in Zambia, so agriculture, was okay. So it was dropped to 13.5%. So I just thought I could make mention of that. Now, very important that we also begin to appreciate a concept of reserve requirements. So I think I had mentioned what reserves are. This is the money that is not lent out. Now, if it was up to the bank, and you can quote me here, if it was up to the bank, as in these commercial banks, they would actually want to lend out everything, because one thing that we have seen already now is that the net margin, the net profit margin, okay, is as a result of how much we are lending out. So the more we lend out, in short, as a bank, the more money we make. Okay, so if it was up to a bank, really, they may want to actually lend out everything, because then they would make more money. But regulation says no. Okay, um, we cannot allow that. So they impose a statutory reserve ratio. I think in Zambia right now, not I think, in Zambia right now, it's as of 2026, it's at 26%, this statutory reserve ratio. Okay, so the statutory reserve ratio help us find the required reserves. Okay, so you have to be able to distinguish between required reserves and excess reserves. Okay, so excess reserves, these are the ones that the bank itself decides to keep. That is the money that the commercial bank, decides that they are not going to lend out. But the required reserve is a regulatory required reserve. Whether the bank likes it or not, they need to keep that reserve. Okay, so basically that is how it works. So yeah, so it is. So this percentage is calculated. I mean, so the percentage is multiplied to the total deposits, and then we are able to know how much the required reserves are. So in this example, we find that the required reserves were at the required reserve ratio, sorry, was at 9%. The total deposits 500 million. So basically 9% of 500 million is 45 million. So in short, the amount that they can loan out, the amount of money that they can loan out is 455 million. The 45 million is the required reserve. But if the bank decided that, no, for us, we just want to loan out 450 million, for instance, then it means that the excess reserve is going to be 5 million. Okay, 5 million. I hope you're able to follow, what is going on here. Okay, all right, that's fine. Now, why does the reserve requirement exist? Okay, so the first one really, we'll look at four reasons, but the first one is very important. It ensures that banks meet, withdrawal demands. This is important. So, like I was saying, if it was up to the bank, may want to lend out everything. But then the challenge is, and remember, we are coming from the types of deposits. A customer is supposed to get their money when they want their money. Okay, obviously depending on the type of deposit, but really the bank is obligated to pay that money. And I stressed that these deposits are not the are not owned by the bank. These are a liability, and so they need to be able to meet these withdrawal demands. Okay, I hope it is making sense. We also need to appreciate that we are also imposing this reserve requirement because we want to limit excessive lending, okay, and money creation. So like I said, if it was up to the bank, they may want to loan out everything, but then this is a risk. Okay, this is a risk. And so I think we will talk more about the issue of money creation, I think, in part 3 of these same notes, but you'll be able to see what we are talking about. Okay, next it gives Bank of Zambia, a lever, okay, to tighten or loosen credit in the economy. Okay, so these are money supply issues, isn't it? Okay. And then finally, it is also helping create a buffer against unexpected outflows, maybe a large outflow. So that provides a buffer. So reserves are providing a buffer. Okay, so that's very important. Now I'm thinking of a question. So now, if for example Bank of Zambia wants to slow down inflation, okay, if for example Bank of Zambia wants to slow down inflation, uh, and of course we know that inflation, right, basically is too much money chasing too few goods, isn't it? So what do you think the Bank of Zambia can do to the statutory reserve ratio? Okay, so this is monetary policy management. So if you're viewing this on YouTube, find some time to comment your answer. Okay, yeah, but otherwise the question is, if the Bank of Zambia wants to slow down inflation, what do you think they have to do to the statutory reserve ratio? Okay, yeah, just as simple as that. So that is that. We make some progress here. Yeah, so basically that is that. So for statutory reserves, or these required reserves, they can be basically the money in the vault, so they can be kept in the vault, or apart from this being money in the vault, or it can be deposits with the central bank or Bank of Zambia. Okay, so basically that is that. So remember that all commercial banks in Zambia actually have bank accounts, okay, with Bank of Zambia. So that's why Bank of Zambia is referred to as the banker of banks, isn't it? Because all these commercial banks have those accounts. Now, the deposits, okay, on those accounts is basically the reserves. Okay, so let us make sure that we understand these things. The next aspect is really answering a question like, what happens to your money if the bank fails, right? So what happens to your money, right? What happens? Okay, to your money, okay, if the bank fails, if the bank, okay, if the bank, fails. Okay, so I think that is what this section is trying to do. Now, the answer really is deposit insurance. Okay, so the answer to this posed question is deposit insurance. Okay, yeah. Okay, so like in the case of Zambia, we have the DPB. Okay, now DPB is basically the Deposit Protection Board. Okay, so in Zambia we have got the Deposit Protection Board, and it is the one that is helping provide, a safety net. Okay, in the event that a bank fails and we need to protect, the customer. Okay, so as already alluded, it was established under the Banking and Financial Services Act. Okay, so all licensed, okay, remember licensing, so all licensed commercial banks are actually members here. Okay, so what do? The banks pay levies. Okay, so member banks pay levies or premiums. Okay, so you can think about them like insurance premiums. So they pay these monies into the fund. Okay, okay. So if a member bank, for example, becomes insolvent and is unable to pay its depositors, then the DPB, okay, would actually step in and would compensate, the depositors, up to the insured limit. Okay, up to the what? Up to the insured limit. So that's basically what is happening. But really, the appreciation here is that it is preventing bank runs. It is really preventing bank runs. Remember what we said about bank runs. A bank run is a situation where, um, like a lot of depositors, like, or many depositors are trying to withdraw at the same time or simultaneously. Okay, and in that case, basically you find that that is actually what is going to cause, the failure. So the bank may have been sound, quite all right, but because of that bank run, the bank fails, and that's the irony in this whole thing. Okay, so really we are saying that depositors, now we are saying that if depositors know that their deposits are protected, at least this bank run is prevented. Okay, so depositors don't have to panic to withdraw. No. Okay, yeah. All right. Okay, so you can read through this. Very important. However, there is a challenge of moral hazard, unfortunately. Okay. Now, what moral hazard is doing in this case is that, you know, because what is happening is that when the depositors know that their money is insured, they may stop monitoring the bank, right? They may stop asking, necessary questions such as, checking if the bank is taking too many risks, or and so on and so forth. Okay, and that's basically moral hazard. Okay, um, yeah, the complacency that comes with knowing that your deposits are protected. Okay, so now what is happening here is that potentially this could actually encourage the banks to take up excessive risk, okay, with the public's money. That's the problem. So you find that this insurance that has been created, okay, then creates a risk behavior on the part of the bank, okay, but meanwhile it was created so that it protects against such. Okay, and really these are the unintended, consequences in financial regulations, and so these are the equations that we are trying to solve even in financial regulation. So let's see how best we can discuss some of these some of these things. Okay. Okay, so let's move to an interesting concept here. A concept of money creation and the money multiplier. So look at the simple money multiplier, but this is very, very, very important. So here, what we are trying to look at is you need to know that as banks, banks can create money from thin air, really. Okay, so it's not even through printing new notes or whatever, but money can be created by these banks from credit extension. Okay, and then the multiplier formula, we need to look at it, and then the different monetary policy tools. Now, let us look at this example. So this example, we have a situation where we have an initial deposit, okay, of 100,000 kwacha. So this is the initial deposit of 100,000 kwacha, and then for the reserve we are using 10% just to make things easy, and then we also have a column for loans created. Now, from the background, you know that for every deposit there should be a corresponding reserve, and in this case we are saying that the reserve is the statutory reserve is at 10%. So if this 100,000 kwacha deposit comes in, we apply the 10% reserve, then the reserve amount is 10,000 kwacha, isn't it? Meaning that the difference, which is the 90,000 kwacha, can be loaned out. So it becomes a new loan. Okay, so whoever has borrowed this amount, the 90,000 kwacha, all we need to do is just we just credit the account, right? So that's all we need to do, credit the account. So you may not have had any money today, your account is zero, but because you applied for a loan and it has been approved, tomorrow you find that there's a 90,000 kwacha, right? Where did it come from? It has been created, money being created. Okay, so now this 90,000 kwacha that you find in your bank account will be treated as a deposit, isn't it? Okay, because remember that now it will become an asset to you and then a liability to the bank. Okay, so now this deposit again will slap a 10% reserve, okay, against it. So that means a 9,000 kwacha in reserves, and then the rest of that amount can basically be loaned out. Okay, again, this amount that has been obtained by someone, okay, will be treated as a deposit, and then we'll slap the 10%, and then the new loan that we can create is 72,900. Okay, the 72,900 is a new deposit. 10% of it is this, the rest we can loan out. Now, so this process really continues, and we are saying that the process continues until new deposits basically add up to zero. Add up to 1 million in this case. Okay, to 1 million. So obviously the next question is, but how did you know that it will add up to 1 million? Okay, so it is through the multiplier. Okay, the multiplier is simply equal to, so the money multiplier, okay, the money multiplier, okay, is equal to 1 over the statutory reserve ratio. So 1 over 0.1, isn't it? Okay, and then you find that it is equal to 10. So this money multiplier basically multiplies the initial deposit, and that was the initial deposit, it was 100,000 kwacha. So multiplied by 10, then it is going to be a million. So that is basically how we knew, isn't it? So this is the amount here that we're talking about. Okay, so the reserves also at the time when we exhaust this the initial deposit, then the reserve would be 100,000 kwacha, and then the actual loans or the actual amount we would have created would be a 900,000 kwacha. From the original what? From the original 100,000. So the from the original 100,000 kwacha, we have managed to create 900,000. This is the power of money creation. And now you see why, if it was up to the bank, they would want to lend out everything because they would make more. Okay, they would actually make more. Okay, so those are the issues. Yeah, so we make some progress. um okay, but what we are saying is that this bank, or these banks, um may not really, because there is a limit to how much they can make, and so sometimes you will need to answer the limit to how much they can make. Okay, and what influences that limit. Okay, okay, yeah. So I was saying that there's a limit to how much can be made, and what is influencing that is obviously uh, your reserve ratio. Okay, your reserve ratio. Just a minute. Let me just get the pen here. Yeah, so what influences that is, sorry, I'm going to just write them here. So what influences that is the reserve ratio. Okay, also, um, the fact that borrowers can decide to go for cash, okay, or decide that they need cash instead of deposits, because you will notice that cash or currency can't be multiplied. Okay, the only thing that the banks are multiplying is what is in their custody, which is deposits. But if someone prefers that they want cash instead of their money in the bank, then that whole process is limited. Okay, and also the other limitation could be the actions of the bank itself. So this was the action of Bank of Zambia. This is the action of the customer, but also the action of the bank, such as excess reserves, right? I think I talked about excess reserves. So you find that above and beyond the 10%, a bank decides that even an additional 5% will not be will basically not be loaned out, right? So because of that, you find that because they are not loaning out that amount, then their money creation is limited. So please remember these factors. It is very important. Okay, but for now, we want to quickly go into the aspect of liquidity management. Okay, we want to quickly go into the aspect of liquidity management. Okay. Okay, so I think it is very critical for us to distinguish between, and I know I've seen a lot of people in finance, confuse these concepts, the concept of solvency and liquidity. I think it is very important that we make that distinction very, very, very important. Um, so when we talk about solvency, really, what we are saying is that a bank, for instance, a bank is solvent if its total assets, are exceeding its total liability. So if total assets are greater than the total liability, then a bank is actually solvent. In other words, we are saying it has got a positive what? A positive net worth. You get the point. But when it comes to liquidity, what we are saying is that liquidity is the ability, okay, to meet cash obligations right now, right this hour, right? Are we able to pay these depositors right now if they were to withdraw today, right? So that is where the challenge is, right? Okay. So yeah. So because how you look at it is, imagine, okay, imagine for instance, a bank maybe has got 5 billion in mortgage loans, right? So maybe 5 billion in mortgage loans, okay, 5 billion in loans, mortgage loans. Okay, now this is an asset to the bank. Remember, loans are an asset to the bank, and perhaps this figure is helping the assets to be more than what, liabilities, isn't it? Okay, but now but then what if a depositor suddenly wants maybe 500 million, okay, 500 million overnight, okay, we are most likely not to manage to pay this depositor back, okay, because the bank may not, these assets that we have talked about, like the mortgage, these are not assets that you can easily liquidate, or you can liquidate fast enough, right? So ideally you may not pay. Okay, ideally you may not pay, and these are the issues around the different financial crises that we have actually faced in this in the world, like the 2008 financial crisis. It was mostly because of liquidity issues. You'll find that banks have held, they have got assets which actually look good on paper, but then they couldn't be sold quickly enough, isn't it? And then basically that was the challenge. So it resulted in banks failing, and government bailouts, and so on and so forth. So those are the things that we need to look out for, really. Okay. So as a banker, this should be engraved in your memory, the fact that a bank can actually be solvent but be illiquid. It is possible for a bank to be solvent, i.e. more assets than liability, but be illiquid and still what, and still fail. Okay, so those are the issues. So remember that. Okay. All right, I think yeah, because of the financial crisis that had happened, especially in the 2006, there were the issue of the Basel Accords. Okay, but we're going to discuss them a little bit more as we go. But the Basel Accords were just a comprehensive set of rules to just help banks to be more resilient. Okay, to help the banks to be more resilient. Now, because we are looking at liquidity management, some of the rules around liquidity management from the Basel Accords was, the two which are important is the liquidity coverage, okay, ratio. Okay, so the liquidity coverage ratio. So this one addresses short-term liquidity issues. Okay, so in other words, the rule here is that a bank, a commercial bank, must hold enough high quality, assets, liquid assets. They should hold enough quality liquid assets to cover all unexpected net cash outflows over the next 30 days. Okay, so you should be able to have enough liquid, high quality liquid assets that can cover um, you for 30 days, that can cover the cash outflows or the withdrawals for the next 30 days. So types of high quality assets would include your cash, um, the reserves, as well as investing in government securities, isn't it? So having that. But really, we want that you should be able to survive what we call the 30-day acute, okay, liquidity crisis. Okay, very, 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 very important. Okay, very, very, very important. So you look at that calculation, which is the loan cover ratio. Okay, if you can have high quality liquid assets, maybe of 2 million, and then you have the net cash outflow of 180 million, you just divide that, right? So in that case, then it simply means that the bank has passed, okay, because it is basically above 100%. Okay. All right. Now, on the other hand here, the other ratio to look out for is what we call the net stable funding ratio. Okay, the net stable funding ratio. Okay, so this one really it addresses the long-term structural funding. Okay, um, what are we saying? Because it ensures that the bank is not dangerously over reliant on short-term funding. Okay, because what we know is that if you are too reliant on short-term funding, then that could actually operate in crisis, right? So the short-term funding can actually evaporate in crisis. So what we want is to also have some kind of stable funding, and we look for assets such as equity, okay, long-term debt, stable retail deposits, and so on and so forth. But really, as I've said, the purpose is to ensure that there's some structural funding stability, and we are preventing the over reliance on short-term wholesale funding that can disappear quickly in crisis. Okay, so those are the critical distinction really. This one we are addressing the short-term needs, 30 days. This one we are looking at long-term, more than a year. Okay, and yeah, so basically we are looking at these assets being more than above the 100% 100% mark. Okay, so then we go to operations. The bank operations will be getting done shortly. Um, so we'll talk about issues of knowing your customer, payment systems, reconciliation, and then fraud controls or detection. I think these you can maybe just study them in your notes that I've provided. But really, whenever a bank accepts a new customer, there are a couple of things that we need to look at, especially answering some fundamental questions, right? Like, who is this customer, right? Where is their money coming from? Okay, and also uh, what are you going to use this account for? Those are the three fundamental questions, so that we know this customer. Okay, who are you? Okay, where does your money come from? Okay, and what are you going to do with this account? Okay, so that's basically that. So the process really is know your customer. So knowing your customer, all we are saying here is that this is just due diligence that you're doing. Okay, so the bank has to do some kind of due diligence on a customer. Okay, and so we call it CDD, right? So customer due diligence, and it is not optional. it is actually a regulatory requirement under the Banking and Financial Services Act. Okay, so that is that, and we may have mentioned this even in our last session that we had. Okay, so basically that is that. Yeah, so I think just look at your notes, and then we should be able to see what else we can do there. Yeah, I think other important things maybe that I can mention is the issue of PEP, which is politically exposed persons. Um, so really, we need to do, especially when, because politically exposed persons are considered to be high risk customers. Okay, so even the due diligence that we do should be enhanced, right? We need to do enhanced due diligence when we are looking at politically exposed people. So politically exposed, anyway, what we mean is it's really any person that is holding or having a prominent public position, right? So maybe these can be government ministers, senior officials, okay, and so on and so forth. Okay. You are asking the question, why are they a high risk? Okay, so they're a high risk because their position gives them access to public funds. Okay, and there is so much potential for corruption, isn't it? So that's why banks must really go an extra mile in terms of scrutinizing these people. Okay, not because they're guilty or anything, but because uh, basically their risk profile demands that, right? Okay, so that is basically that. So we need to do ongoing monitoring as shown here. Okay, we constantly have to monitor just to ensure that we are able to detect if there is any unusual patterns, okay, that might indicate maybe money laundering or fraud, isn't it? Okay, so that's basically that. But you can do more of your studies on your own here. Okay, so that we see if we can conclude. Okay, payment system in Zambia. Okay. Yeah, I mean, of course, you may already know that. I mean, millions of transactions are being processed. So ours is to understand what infrastructure actually makes this possible, right? So in Zambia, we have got the zips. Okay, so this one, the zips. So zips is the Zambia Interbank Payment and Settlement System. Okay, so really, settlement is being done in real time, meaning that every transaction is settled individually and immediately. So there is no batching, no netting, no delay. Okay, that's what we mean there. Okay, we also have the automated clearing house. Okay, yeah. So that can also be used to process transactions. For international transactions, we have got what we call the SWIFT, okay, Society for Worldwide Interbank Financial Communication. That is also important for us to understand. Okay? Yeah, so you find that every bank, every international bank has got a SWIFT code or identifier. So this is enabling for international transactions. Yeah, other than that, I mean, even mobile money, right? Yeah, mobile money transactions can be done, like we have Airtel money, MTN money, like in Zambia here. Really, like I mentioned, this has absolutely transformed financial inclusion in Zambia, and I think in generally in Africa, right? Okay. Yeah. Okay. So card networks, obviously. Okay. And so on and so forth. All right. What about the issues of fraud prevention and key operational issues? Um, yeah, I think we have noticed we are emphasizing on the issue of fraud. It's a serious issue. So some controls will have to be in place. Okay. This is just something that you can study on your own. What are some of the internal um, uh, you know types of frauds that can happen? Okay, it might be the issues of account manipulation or just stuff theft, isn't it? The famous case of Pamela Gondwe in Zambia, okay, something that is a good example, right? Um, so because of this, you find that um, we need to do some kind of like internal controls, such as a marker checker. So when one member of staff enters a transaction, a completely different member of staff who is the checker will independently verify, okay, before um, processing can be done. So in the end, you find that no one person is approving and verifying some of these things on their own. Yeah, so no single transaction basically above a certain threshold can be processed by a single individual alone. So the other one, yeah, phishing, forgery, anyway. But key operational controls, you find that we can also do what we call segregation of duties. Okay, meaning that no one person controls an entire transaction from start to finish. Um, like I mentioned, the person who initiates a payment should not be the same person who actually approves it, and neither should be the person should should it be the person who actually reconcile it. Okay, so really that is that. So you can't control the whole transaction. Okay, that is a recipe for fraud, isn't it? Okay. Um, what else is there? There's also the issue of geo control, which means that certain high risk activities, for example, like if you go to the bank, the issue of like opening the vault, or maybe like processing a very large payment, or just accessing like sensitive data, will require that two authorized people be present, okay, at the same time. All right, so that's basically that. This is very important. And also, don't be surprised when we also when you go to the bank and we are looking at the issues of audit trail, isn't it? So this is like a complete record of every action taken on every transaction. So things like who did it, when was this done, and which terminal, all this is documented. So there is a complete record. Okay, so this is actually what helps us have a foundation for fraud investigation. So if there's going to be fraud investigation, this is what is helping us with that. Okay, the issue of audit trail. Okay, so that is basically that. It might look like it is bureaucratic or something, but really the advantage is that it is helping the bank operates whilst minimizing losses. I think that is the the upside that we can talk about. Okay, what else do we have? There's asset liability management. Okay, again, due to time, we may not do too much, but this is the final content for today. Just to look at the issue of asset liability management. Um, yeah, so just so that we can just bring everything together, right? The issue of deposits, the issue of pricing, the issue of liquidity, the issue of operations. Now we just bring them together, so that we just have a bit of an understanding. So some of the things that we need to understand here quickly is okay. So just to, as we are concluding, the biggest challenge, the fundamental structural problem that banks have is that they borrow short, isn't it? So they borrow short, and we mean these deposits that they get from customers. I think we talked about it. So they borrow short, but they lend long. So depositors want to have access to their money within days or months, meaning yeah, short term. But then borrowers, the ones that are coming to borrow, want money for mortgages or maybe business loans, and you find that these have to last, a number of years. So really, because of that, it is actually causing, an organic mismatch. Okay. Okay, in terms of like the interest rate. Okay. Okay. And so this results into what we call the interest rate risk. So the interest rate risk um, is just a risk that changes in market rates will hurt the bank's profitability. So the risk that changes in market rates will affect the bank's what profitability. That is where the problem is. And what helps measure that is what we call the repricing gap. Okay, so the repricing gap is what measures our our interest rate risk. Okay, and basically the formula is the rate sensitive assets minus the rate sensitive what liabilities. That is just it. So running through this quickly, you find that in situations where the repricing gap is positive, okay, i.e. you have got more sensitive assets than you have for liability, then it means that when interest rates increase, you'll be able to benefit, okay, from the rise, okay, because your assets are adjusting, or they are repricing faster than your liabilities, isn't it? Okay, yeah. So meaning that your net interest margin will basically improve. But then if interest rates fall, then the opposite happens, and that's where the challenge is. Okay, so the reverse happens and the bank will be hurt. Okay, you can have a negative gap where you have got more liabilities that reprice than assets. Okay, so basically here what we are saying is that then the rise in interest will definitely hit the bank because the liabilities are rising faster than your assets when interest rates rise. But meanwhile, when interest rates fall, then the opposite is the case, right? So at least you tend to benefit. So and then you also have zero gap where you have got equal repricing on both sides, isn't it? So both these don't change. So in practice, usually you'd find that most banks would run a slightly positive gap. Okay, they would mostly run this slightly positive, so that they can benefit from this rise, but at least they are able to work around um, issues of deposits and loan repricing, so that they don't so that they are not badly affected when interest rates basically fall. Okay, so those are the issues that I thought I could discuss. Um, yeah, um, I think that diagram really is self-explanatory. It's just talking about how the responsibility of the alcohol. Okay, so they are the ones who actually set um, deposit and pricing. I mean, deposit pricing and lending rates. They are the ones who do that. Okay, like I mentioned, they use the MPR, so they are guided. They use the MPR mostly um, to basically benchmark. Okay, so that is the issue. And also, I think monitoring competitor behavior. We talked about this. Okay, as they are coming up with pricing. But other than that, the ALCO also monitors things like the what's this the the LCR, okay, the NSFR, as well as the cash what, as well as the cash flows, okay, so that basically so that we ensure that banks are always meeting regulatory what requirements, isn't it? Okay. Um, Other than that, it is managing um, interest rates, okay, and and foreign exchange rate, isn't it? Okay. And I think we talked about this, especially the issue of repricing gap. But anyway, we'll have a whole course dedicated to some of these things, like your risk management. I think we'll do more of this. Um, yeah, okay. A number of things. They also review investment portfolio strategies. Okay, so yeah, so basically they decide how the surplus liquidity. Okay. Oh, sorry. They decide how to deploy surplus liquidity. For example, do we put the surplus in government securities, or maybe we do interbank placements and so on. Okay. They also manage the issues of duration. I think I've talked about this. Okay. That especially the maturity structure. Okay. And then also the issues of ultimately, the decision comes from the alcohol committee. Okay, so just look at the different takeaways, the different formulas that we have. Yeah, just have time to study those things. I think it is very important. So I think we have done a great deal of work today. We moved from just banking to looking at the balance sheet a little bit, how it is being managed. Okay, the issues of deposits and money creation, liquidity operations. I think that was very critical. A little bit around anti-money laundering and know your customer issues, very important in banking. Yeah, so I think then that has prepared us well, so that in the next section now we can look at the issue of bank lending and credit management. In other words, how do banks decide who to lend money to and how much? That is a very significant question. So let's tackle that question or those questions in the next session. For now, thank you, and please make sure you study these notes and try to answer those questions. Okay.